Hello. Have you ever stopped to think about where the cash in your wallet or the numbers in your bank account actually come from? Today, let's take a look together at how money is really created and what that surprising secret is. Let me tell you something that might sound a bit provocative. You know the money you see in your bank account? It's not actually sitting somewhere physically in a vault. No, this isn't a conspiracy theory. And it's not a system error either. It means that the global financial system has been deliberately designed this way from the very beginning. This system has a name, fractional reserve banking. And to fully understand what it is, let's go back in time to where it all began. Everything starts long before computers existed, with a very clever observation made by goldsmiths in the Middle Ages. Imagine this. Wealthy merchants would deposit their gold with goldsmiths to keep it safe. In return, they received a paper receipt. After a while, they realized that instead of carrying heavy gold around, it was much easier to trade using these paper receipts. In other words, the receipt became just as valuable as the gold itself. And this is where the magic moment happens. The goldsmiths noticed something. No one ever came to withdraw their gold all at the same time. Based on this simple observation, they began issuing paper receipts representing far more gold than they actually had in their vaults, and lending these out with interest. The result was, quite literally, money created out of nothing. There was no physical gold, just a promise. That simple but ingenious trick of the goldsmith evolved over time, developed further, and eventually turned into the massive and complex global banking system we use today. But believe me, the core principle is still exactly the same. In the past, the system worked like this. When you deposited 100 lira into a bank, the bank had to keep, say, 10 lira in its vault as reserves. The remaining 90 lira could be loaned out as credit, but, especially in the United States, since March 2020, things have completely changed. Yes, you heard that right. The number is 0% today in America. A bank you're Elbet. Metni eingilisai. Anlatum GCN Vivirgularini Coriaric Giviriorum. The amount of money a bank is required to keep in its vault against your deposits is exactly 0. So naturally, a question comes to mind, doesn't it? If banks don't have to keep any money in reserve, what stops them from creating infinite money? This is where complex international regulations like the Basel rules come into play. You can think of them like this: a kind of safety brake designed to prevent banks from taking excessive risks and collapsing. In other words, banks are told, for every risky loan you issue, you must set aside a certain amount of your own capital. The limit is no longer reserves, it's capital adequacy requirements. Now please pay very close attention here, because we've reached the single most critical point for understanding modern banking. When you take out a loan from a bank, the banker does not go into the vault, grab a bag full of cash, and hand it to you. No, they simply press a few keys on a computer keyboard and poof, a brand new digital sum of money that did not exist before appears in your account. The money is created at that very moment, along with your debt. Do you know what this means? More than 90% of the money circulating in the economy today is not physically printed cash. It consists of digital numbers in banks' computer systems, all of it created as credit, in other words, as debt-based virtual money. So what are the consequences of a system where money is created this way, through debt for all of us? This is where things get really interesting. We are faced with three unavoidable outcomes. First, inflation. The more credit that is issued, the more money is created and the value of money declines. This is not an accident. Second, an endless debt cycle. Because money is created as debt with interest, even if there is enough money in the system to repay the principal, there is never enough money to repay the interest. This makes further borrowing unavoidable. And third, the concentration of power, because the system benefits those who have the power to create money, banks, and those who can borrow cheaply to acquire assets. These are not flaws in the system. They are an intentional part of its design. So after explaining all of this, what does it mean for you? As an individual, what lesson should we take away from this picture? Perhaps the most uncomfortable truth is this: for the system to survive, we must remain in debt. Think about it. What would happen if one day everyone paid off all their debts? Since money is created through debt, when debts are repaid, the money itself disappears. The money supply would almost collapse to zero, and the economy would come to a complete halt. Once we truly absorb this reality, our perspective on many things must change. 1. The digital numbers in your bank account are not wealth. They are merely a claim on wealth. Real wealth is your skills, your property, and the things you are able to produce. 2. Borrowing is not an innocent act. In this system, debt is a mechanism for transferring wealth from those who save to those who borrow. 3. Inflation is not simply the result of poor management. It is an unavoidable mathematical outcome of a debt-based monetary system. In the end, from the simple paper receipts issued by a medieval goldsmith to the banking app on our phones today, our entire financial system is built on a massive shared story, one based on trust and promises that we collectively agree to believe in. And now comes the most important question. Now that you understand the rules of this story and how the system really works, how do you plan to play the game? Because the moment you understand how the machine works, the power to define your own strategy finally becomes yours.